So welcome to today's class. We had a nice long break. Hopefully you rested well during that 2 weeks, and hopefully also did some form of classes or revision work. So tonight, what we're going to do, let's check some quickly. So tonight we're going to continue with our classes. In tonight's lesson, we're going to do an analysis of financial information. We will be doing a question on, we're going to do the financial analysis question on in that May-June 2017 question paper. And then you're going to have a submission for me for next week from this paper, two of the questions, the capital budgeting question and the weighted average cost of capital question. So I'll tell you later towards the end, I'll tell you exactly which questions you need to submit to me. Then I'll mark it for you guys. The reason why I want to do it, WACC and capital budgeting is quite big questions. If you submit it on time, then I'm going to mark it. I'll take a week to mark it. And what we will do is, besides getting the answer correct, it's more about two things: how you set out your question paper, your exam technique, and then the logical flow of how things are actually, how you set out your workings and all of those type of stuff. So, so I'll tell you which question, but it's basically the WACC and the capital budgeting question, and I think both is in question one. But for tonight, we're going to do financial analysis. Next week, we will do sources of finance and working capital, also from this question paper. So this question paper has quite a few big topics. It has WACC, it has capital budgeting, it has financial analysis, it has sources of finance, it has working capital, and it has valuations. It has 6 of the big topics. All of those topics are huge. Although working capital don't always come in, but when it do come in, it's a good 10 to 15 marks. Source of finance don't also always come in. If it do come in, it could either be like a 5 marker or it could be like a 10 marker, like in this case, it's a 10 marker. So we're going to spend the next few lessons on this question paper so you get a nice feel of working capital, and source of finance. Because working capital and source of finance don't always come in, but the way it's tested in this question, if it does come in, UNISA will test it in this manner. Then there's different ways to test it, but this is a typical manner UNISA would test it. But for tonight, we're going to do financial analysis. The structure is going to be just a high-level overview of financial analysis, probably going to take us 10, 15 minutes, and then we're going to go into answering the questions. So let's go into financial analysis. The question you need to ask yourself is, what is the importance of financial analysis, or what is financial analysis? More specifically, we are focusing on financial statement analysis. Okay, so that's important. We are focusing on financial statement analysis. There are many other types of financial analysis, but we're focusing on financial statement analysis. So why do we do financial analysis or financial statement analysis? It is basically, it helps management identify trends and so forth. And in that way, they can use it to make decisions. So financial analysis is not something done on its own. Like in this particular question, it is a separate question, but in reality, it is basically when you prepare, as a financial accountant, if you prepare your monthly management accounts, that's the first step you're going to have to do. The next step you're going to have to do is to compare your current month to the previous month or current month to budget. So once you will then do a variance analysis, and you will try, and once you pick up the big variances or the significant balances, you would then analyze what caused the movement. So you will generally do financial analysis on those type of things. In audit, if you're in third year, generally at the if you do audit at the Big Four, in most cases you when you're in third year you run the client. Sometimes in second year, but mainly in third year you run the client, and it's since you run the client, you basically deal with the planning stage of the audit. And part of the planning stage is to identify, to get a high level overview of the business in the current year, as well as to identify risks. One of the ways that they do that is they pull in the trial balance, the full trial balance, and they compare current year to the prior year, and they do like an analytical review. They basically look for high level movements, and they perform some form of financial ratios. So financial analysis is an important topic, but what you must understand, it is not done in isolation. It is done with a purpose behind it in order to make some form of, or not to make, but to help you make decisions. You will use financial analysis together with other pieces of information to help you make decisions for whatever reason. In invest, if you an investment analyst, if you're investment banking, then they do financial analysis to another level. Um, the way they analyze financial statements is on another level. So financial analysis is an important aspect. So just take note of that. So that is basically the importance and the why. So the why, we use it, we use financial analysis for further to help you make decisions. Okay, so just keep that in mind. What's important to understand when it comes to financial analysis on its own is meaningless. It is useless unless you're comparing it to something. So you'd either compare it to the prior year or prior month's balance. You'll either compare it to your budgeted figures. You'd either compare it to an industry benchmark, or you'd either compare it to a competitor. But you're going to compare it to something. Without comparing your current ratio to something, it's useless. You can't analyze anything. So just keep in mind you have to compare it to something. And before we jump into financial analysis, what you must understand is that there are tons and tons and tons of ratios. Okay, we're going to be covering the most common ratios. In an exam, they can ask you for ratios that you've maybe never came across, but based on your understanding, you should be able to come up with a ratio. Typically, what they ask you nowadays is ratios that is not really financial information, right? Just like carbon dioxide, CO2, this employee turnover, all of those type of stuff they ask you. But understanding your typical financial ratios, you must be able to perform those ratios based on what they are asking you. So just by looking at the name of the ratio, you must be able to perform or calculate those other ratios that you might come across. That's from an exam point of view. From a real world point of view, there are also plenty and plenty and plenty of ratios. All you have to do is basically pick up financial statements and look at what they generally in the CFO report or the chairman report or the CEO report or somewhere there, or by the strategic part of the business, they will talk about their key metrics. Then you will come to realize there's many other ratios that the company takes into account, and it's generally specific to the industry. Now, as for those of you going on to the CA qualification, and MAC 3702 is not only for CAs, but because it's one of the courses that is required to get into CTA, which is for CAs to a large extent, SAICA does not require, or SAICA, the whole purpose of the CA qualification is to help you become a general CA. SAICA does not focus on specific industries. So, for example, the financial services industry, like banking, insurance, they don't look into detail in those type of things. You may get a scenario about financial services, but the specific details regarding those industries is not required. Same with mining, same with oil and gas. The specific details regarding those industries is not supposed it won't be tested. So any accounting treatment specific to those industries, any tax treatment specific to those industries are not tested. However, the financial services employ a large amount of CAs. So when you're going to the financial services industry, there are stuff that you haven't learned as a CA, but you're required to do it within your job. So for example, um, when I went into financial services as a financial accountant, I never did financial services in audit training, but I happened to join a financial services company as a financial accountant. One of my responsibilities was to calculate tax for a long-term insurer. The textbook we used that I studied, and is a textbook used in the real world as well, because supposedly apparently it's a very good textbook. So I thought, okay, cool. I never learned this at university because it's not part of the scope. Let me go to the textbook. I looked at the index. I'm like, yes, cool. There's long-term insurance, and I go to the page. When I go to the page, it says long-term insurance. Look at section whatever. I can't remember the section number, beyond the scope of this textbook. So it wasn't even in the textbook; it was beyond the scope of the textbook. Yet you are required to perform a financial income tax calculation for long-term insurance. It's very different, very, very different from a typical income tax calculation. But you are required, because you have some knowledge, you must be able to apply what you have learned and adapt yourself to the specific industry. Now, same thing in financial analysis. You may not be exposed to it. Like we're going to cover the general, the typical ratios, but there may be one or two ratios that will be new that you must try and figure out. And based on your practice, on your typical ratios, you should be able to come up with the ratios that they give you in the exam that may be different. So for example, if you pick up a financial services industry, financial statements, there are a few ratios or metrics that is key to them. If you look at if you pick up a healthcare company, so for example, pick up Life Healthcare, Google Life Healthcare annual report. Some of the key metrics they talk about number of beds. They talk about days that the patient was in the hospital. So those are ratios or key metric information that we don't cover. But if you get that as a scenario, you must be able to calculate those type of things. So just take a note. Although we are learning specific ratios over here, you must learn it in a manner and be prepared to expect any other ratio as well. So that's the second an important aspect. The second thing I want to make mention of is how you calculate a ratio. We can calculate it in a specific manner. However, in the real world, the same ratio can be calculated very differently, and that's okay. It doesn't mean you're wrong and the other one is right, nor does it mean that you are right and the other one is wrong. Both can be correct. It just depends what they are calculating, what they are looking for, and even if you're doing the same thing, using some different numbers is totally okay as long as you are consistent. So for example, I'll give you an example. One of the ratios that you will come across is known as the debt equity ratio. The more technical, the more technically correct way to calculate the debt equity ratio is to say long-term interest-bearing debt divided by total equity. But if you maybe Google, they will tell you total debt divided by total equity, which is very different. Total debt divided by total equity is very different to long-term interest-bearing debt divided by total equity. But both can be okay, both can be right. You must just be consistent year in and year out. Why I'm telling you this, when you go into the real world, don't just think that what you learned is the only way. There are many other ways. So when you see something different in the real world, don't just say it's wrong. First, understand why they are doing it that way, what's their thinking, do your own research, and then come to a conclusion. So just be very careful on that. Another example is, um, but maybe it will be something more relevant in CTA, not so much in undergrad. It is return on equity. So return on equity is net profit divided by equity. But the question is, in CTA, you're mainly going to come across group companies. So therefore, they have a total equity, they have a parent equity, and they have NCI. Similarly, they can have total profit, parent profit, and NCI. So which one do you use? Do you say total profit divided by total equity? Do you say parent's profit divided by parent's equity? Both is fine, but it depends what you are looking for, what's more important to you. If they're silent on it, you choose what you want to do, but just make sure when you compare one year with the other, it's consistent. That's the key thing. So please just take note of um, those kind of things. So in financial ratios, it's very real. Like if you pick up some textbooks, they'll give you for the same calculation 3 different calcs, and that's only the most common, not even all. Then you go Google and take Investopedia. Investopedia will calculate something very different to what the textbook tells you. So they may all be correct. So don't think that the way we learning is the only way. So that when you head into the real world, don't just think that people is doing, if it's different to what you know, that they are doing the wrong thing. So just take note of that. Okay. So now let's go into what we're actually going to learn and for your exam purposes. We're dealing with financial analysis. Okay, so the whole purpose here is to do financial statement analysis. We spoke about the reasoning of financial analysis. There are at least 4 approaches to financial statement analysis. You get the common size approach, you get the index approach, you get the comparative approach, and then you get the ratio analysis. The other 3 you're not going to bother with. You can read up on it and just have an idea about it. But what we're going to focus on is ratio analysis. Now, when it comes to a ratio analysis, about 4 to 5 things you must be aware of. Actually, 4 things. Number one, you must be able to know the categories of ratios. Now, there are plenty of categories. We're going to focus on the typical categories. So when we talk about the category, we're referring to profitability is a category. Debt management or liquidity and solvency is a category. Asset management is a category. Um, Cash flow ratios is a category, and so forth. So there are different categories of ratios. Why is important? In some cases, they're going to say, dear student, please determine the profitability, or please analyze the profitability of the company. Dear student, please analyze um, the debt management of the company. So then you must know that that is a category of ratios. So that leads us to number 2. Once you know the categories of ratios, you must then know the different ratios that make up the category. Once again, there are plenty of ratios, but we will cover the most common ratios that make up each category. So just take a note. Number 1, you must know the category of ratios: profitability, debt management, liquidity, solvency, asset management, whatever else. Then you must know the various ratios that make up each category. So for example, under profitability, you have change in revenue. Under profitability, you have the net profit margin. Under profitability, you have operating margin. Under profitability, you have gross profit margin. Under profitability, you have return on assets, return on equity. So you must know the various ratios that make up each category. So now you know the categories, now you know the ratios, and now you must know the actual formula of the ratio. So for example, one category is profitability. Within that, we have gross profit margin. Gross profit margin is gross profit margin equals gross profit divided by sales. Similarly, operating profit divided by sales. Net return on assets, operating profit or earnings before interest and tax divided by What did I say? Divided by total assets. So it's those type of things you must know. So number one, you know the category. Number two, you know the ratios that make up each category. Number three, you know all the formulas that make up each ratio. And once you learn the formula, at the same time, simultaneously, you learn what the ratio tells you. So, for example, gross under profitability is a category. One of the ratios under profitability is gross profit margin. Gross profit margin equals gross profit divided by sales times 100. And now you will say, okay, what does this ratio tell me? This ratio tells me that for every 1 rand of revenue, how much profit, how much gross profit am I generating? So just, you must know that. So once you have those three, now we come into number four. Number four is to comment on the ratio. I'm not sure how strict undergrad is, but I'm pretty sure CTA will be very strict. The reason being is in the PSYCA ITC exam, they are extremely strict when it comes to ratios. And it's got to do with the commenting. If you calculate a ratio and you get the ratio 100% correct in terms of your calculation, but you did not comment on the ratio, you get zero. They don't mark you. So you must comment on the ratio in order to get your marks. So that is why commenting is so important. So the question is, how do we comment? So I'll give you a way to comment for exam purposes. Then I'll explain a little bit more detail on how to comment if you do it in the real world. Okay. So for exam purposes, there's basically three things you will do, either two or three, maximum three. Number one, you must state the obvious. What is the obvious? Is either the ratio improved or it deteriorated, or increase or decrease. Only if they say use increase and decrease, then you use the word increase or decrease. If they are silent, you use the terminology improve or deteriorate. That's number one. So you state the obvious. Improve or deteriorated. Number two, you must give a reason for the improvement or a reason for why it deteriorated. Now, you must not write a thesis. You have to just write one line, one sentence. So please take note of that. The important aspect regarding the reason is to link it to the scenario. You must not have a generic answer. So, for example, a generic answer is the textbook definition. So, like for example, the gross profit. The purpose of the gross profit definition is to tell you that for every 1 rand of sales, how much gross profit was generated. Now you can't say improve and say the so let's say the ratio improved. You can't say the ratio improved because the company generated more profit for every 1 rand of sales. We know that. We know that's a general. We know that is what the ratio is telling us. We want to know why. So you must always ask yourself, why did it improve? Okay, so that's important. The only time you give a generic answer is if there's no specific details in the scenario. That's highly unlikely, but there are cases I've come across questions where there's no specific details. So then you can use a generic answer, but you still somewhat link it to the company. So just keep that in mind. But if there are specific details, you have to link it to the scenario. Don't give a generic answer. So we said, number one, when you do commenting, state the obvious, improve or deteriorate. Number two, give a reason. The reason must link to the scenario. But in order to give a reason and to link it to the scenario, you need to know what the ratio means or what the ratio is trying to tell you. So for example, like we said, the gross profit margin ratio is telling you for every 1 rand of revenue, how much gross profit you are generating. So that means if the ratio improved, if the ratio deteriorated, you can tell them, give a reason. And because you know what the ratio means, what the ratio is trying to tell you, you should be able to pick up a reason from the scenario. So it needs to be within context of the scenario. Like we said, if there is no context, then you can give somewhat a generic answer. Then step three. Step three only comes into play if the ratio deteriorated, if the ratio is bad. So what would you do over there? If the ratio deteriorated or if the ratio have a negative impact, then you must suggest or recommend a, an improvement. You need to recommend how they can improve the ratio. So just take note of that. So that's how you comment. Remember the reason, one line, not a thesis. You only need one mark. So there's no point to write a thesis. Okay. So that's important. But now let's actually, how do you comment in the real world, or how do you analyze in the real world? Like we said, like an investment analyst, the way they analyze ratios is on another level. Now, you can't tell your the investment. So the investment analysts generally prepare a report for the portfolio manager. Now, if you must give a portfolio manager and tell them that gross profit increase, so that means that they are generating more gross profit for every revenue, they're going to laugh at you because that they know that. They want to know why. So the way you analyze a ratio is looking at what makes up the ratio. So for example, let's stick with, or let's use net profit. Net profit is equal to net profit. So net profit percentage is equal to net profit divided by revenue. Now I'm going to simplify my explanation just to illustrate what I'm trying to bring across to you. That ratio can increase or can improve in two ways. The ratio can improve in two ways. Net profit can increase while revenue remains the same. So let's say, so like I said, I'm just simplifying to illustrate my point. So if revenue, which is in the denominator, remains the same and the numerator net profit increases, then the ratio will increase. So that will generally be positive. It's somewhat positive. Although revenue remain the same, you're not too happy that the revenue remained the same. But the fact that revenue remained the same and you still generated a higher profit, that's a positive, which it means you are managing your cost really well. So that's a positive. Okay, so that is one way. The second way is like I'm going to say again, just to simplify my point. Let's say net profit remains the same relative to last year. So last year was 100,000, this is also 100,000. So net profit remained the same. So the only way that the ratio can increase is if revenue decrease. So if the denominator is smaller, the ultimate answer becomes bigger. So now the ratio also increased. So net profit also improved. But this time, net profit improved as a result of revenue decreasing. Now, the question is, are you happy with that? It's still positive because you have a smaller revenue, the same net profit. It means that your cost control measures are good. However, are you happy that the revenue is becoming smaller? Well, we can't say yes, we can't say no. It all depends what management is trying. So, for example, if revenue became smaller because the company lost market share, that is bad news, because they never made revenue smaller within their control. Revenue became smaller with something outside of their control. They're losing market share. Okay, because customers are going elsewhere. So that is negative. No one likes to lose market share. Another way revenue could decrease is if management decided, so let's say they sell on credit, they decided to have a more stricter credit policy. By having a more stricter credit policy, less people can buy on credit. As a result, they'll have less revenue. So then you'll have to analyze, is it a good thing or is it not a good thing? We don't know, but you'll have to look at it in the context of the business. So you can see in the real world, even though on the face of the answer, there's an improvement in the ratio. Is that improvement really good? That is what you need to find out. Similarly, like I said, with the first example where revenue remained the same, which is not necessarily a great thing, because you want the revenue to increase. Remember, revenue in the real world is a massive number. It's a very, very important number. If you are a public company, analysts is always looking to that revenue number because they generally look at your size when they look at the size of the company based on their revenue. And also, the more revenue you're making, it shows that you're still moving forward in life, basically, as a business. So the revenue number is a very important number. But let's say for argument's sake, they remain the same. And we say net profit increased. As a result, the net profit margin increases. So the only way that that could have increased is as a result of a cost control, good cost control. The question you need to ask yourself is, what are the cost control measures that have taken place? Is it sustainable ones or is it non-sustainable? So for example, if you manage your costs by cutting number of employees. Remember, the two major costs for most companies is cost of sales and salaries. So if you're not in a business that have inventory, then your biggest cost is most likely going to be salaries. But if you're a manufacturer or a retailer, it's going to be cost of sales and salaries. So to make a dent in cost savings, to make a real dent in cost savings, you have to look to cost of sales and you have to look to salaries. You can look other places as well, but it's not going to make a dent. So if you have net profit margin, if you have a net profit margin savings, I mean, if your net profit margin increase but the revenue remain the same, so that means your cost control appears to be good. But you need to look further. How did they control costs? Was it by cutting staff? If it was by cutting staff, you'll have a look, okay, were they really overstaffed? If yes, then positive. But if they're just cutting staff to really just save costs, they can only cut staff to such a point. They can't cut staff continuously because then they're going to have no staff. And if they cut staff too much, there will be other problems. So that is not a sustainable level of cutting. Okay. Similarly, many companies, the first thing they do is they cut those extra costs relating to employees. They cut training, training and development. They cut tea and coffee, as if tea and coffee is going to make a dent in the cost cutting. Now, ignore tea and coffee, but training and development, that is huge, because even though training and development may save you some money now, but it's short-term thinking. You are not preparing your staff for the future. You're not equipping them for the future. So you may end up with a future problem. So then is it really a good thing? So you see, it's all of those. That is the level that investment analysts analyze. They go into the why. You ask yourself, net profit increased. Okay, cool. First question, why? Get an answer. Then ask again, why? Get an answer. Ask again, why? At least ask 3 whys. Try to get to 5 whys, and you should get to the bottom of the answer. So that is the level that you will analyze in the real world. For our purposes, for exam purposes, you're not going to analyze to that level. It's going to be a plain and simple one-line answer. But what I just wanted to show you is that you need to, that is, ratio analysis is not as simple as we do it here in the academic world. It's a lot more deeper. And like I say, investment analysis is thorough because they look they before they even analyze the numbers, they first look at the accounting treatment, the policies, or how was that number calculated from an accounting perspective. And there's a lots of details that they go through over there. So remember, you can go into a lot of detail and to actually understand what are happening, but not the way we analyze. that is not the way you analyze in the real world. It goes a lot more deeper. So I gave you just a touch of it. I hope you appreciate the level of detail you actually have to analyze and to really get a little bit more understanding of the business. The next thing you also look at too is to think of the journal entries. So, for example, let's say a revenue increase. The only way revenue can increase is by saying credit revenue. For every credit, there must be a debit. The debit can be one of two things: either debit bank if you sold for cash, or debit debtors if you sold on credit. So, that can tell you if revenue went up by 20% and you see debtors also go up by 20%, that tells you that all of the sales was on credit. That must pose some risk to you. Like, is it the real sales? Did they just put through sales fictitiously? Or even if it is real sales, how much of that sales is going to actually turn out to be good? Because how did they all of a sudden get 20% increase? Did they lower their credit? Did they change their credit policy to reduce the strictness? That means more people will be able to qualify, which means the quality of debtors is lower, which means you could end up with higher bad debts, things like that. So it is those type of stuff you kind of think of. So the two levels of detail: what makes up the ratio, the numerator, the denominator. You want to understand how the numerator was calculated, how the denominator was calculated, and then also once you understand the movement in terms of improved or deteriorated, you want to ask yourself why. Five whys to get to the bottom of the reasoning. Obviously, with investment analysts, they have a luxury in a sense that they do the analysis, and then they have they get to speak to companies. They phone the CFO, they have a call with the CEO, they have a meeting with the CFO, and the CFO and the CEO explain to them the numbers. So they have that luxury. For us, we don't have that luxury. We might just use the financial statements and assume things. But they use the financial statements, do a thorough level of analysis, and then they will have still some more questions that they can't answer themselves, and then they give the CFO a call or whatever. So they get to speak to management regarding the numbers. Many other people don't. So but how we would go is understand the numerator, understand the denominator, understand how the numerator was calculated, how the denominator was calculated. Once you have your movement, improve or deteriorated, you're going to ask yourself five whys and try to get to the bottom of the answer. Another thing to consider is look at debits and credits. If revenue increase, it's credit revenue. For every credit, there must be a debit. The journal has to balance, otherwise the financial statements can't balance. So there has to be a debit. What could the debit be? And then you try to find the answer looking at the financial statements. That's how you're going to do it in a little bit more detail. As you do it more over time, you become better and better. But that's all I wanted to mention from our side for now. But for our exams, the four things we do: understand the categories, understand the ratios, understand the makeup of the formula and what the formula tells you, and then comment. For commenting, state the obvious: improve or deteriorate. Give a reason, one line reason that makes sense in the context of the scenario and makes sense with the definition of the ratio. And then number three, if there was a decrease, if there was a deterioration, recommend an improvement. Okay, so that is how you will go through it. So now we're going to head over into financial ratios. We're going to do that question in what question was it now? May, June 2017, I think. So May, June 2017. I was going to share with you my screen quickly. So we're doing May, June 2017. So here you can see in question one, capital structure, long-term investments. Capital structure that is cost of capital, weighted average cost of capital. Long-term investments, that is capital budgeting. Then we have analysis of information, what we're busy with. We have valuations, which we're going to get to. And then we have treasury function. I think part of treasury function is working capital and so forth. So here you can see it's 2 questions, 55 marks, 45 marks. In recent years, I think from 2018 or from 2019, one of the two, it is now 1 question of 100 marks, but they will still have the same stuff that is tested. So in question 1, you're going to do question 1, not the entire one. I'll just show you what you're going to do in question 1. So this is question 1, Mike Sports. What I want you to do is part D. So question 1, part D. This is for homework. You must submit it to me next week. You can submit it by next week, Friday. That's fine. You will submit it on the website, on the platform. I will create an assignment where you must submit this. So part D, which is calculate the weighted average cost of capital of MSL. Okay, so you do part D. Have a look what they're asking you based on book value. Take note of that. Okay. And then you must also do part E. Advise MSL board whether or not the new machine should be purchased. Assume a hurdle rate of 19%. You can assume tax is payable in the same year as calculated and acquired. So part D and part E, you must calculate that. We will work through the rest of the question afterwards. So for your homework, submission next week, Friday. If you submit it by next week, Friday, and Friday for me goes up until 12 o'clock the night. If you submit it by next week, Friday, part D and part E, then I will mark it and provide you with feedback after a week or week and a half. Okay. So there's some stuff that is different over here, but it's to test your thinking and so forth. So that is what I want to get to. So let's see, there's something else. Okay, yeah, so just do that for now. So part D and part E. We will then do part A to C, and yeah, we will talk through the other stuff. Oh no, sorry, I need you to do part D, E, and F. Okay, so D, E, and F, I need you to do submission by Friday next week. Like I said, if you submit it, I'll create a place to submit it, and then I'll mark it and provide you with feedback. So now we're going to go to this question over here. Question 2. And we're going to do part A. Part A says, calculate the profitability ratios of Madlala for the year ended 30th April 2017, and where possible, provide reasons for changes from the previous financial year. So here they say profitability ratios, so they're referring to a category of ratios, okay? Now, they were nice enough to give you the category of ratios that they want. So turnover growth, that is a profitability ratio. Gross profit margin is a profitability ratio. Effective tax rate, okay, kind of. Ebitda, that is a profitability ratio. Marketing expenses as a percentage of revenue. You see, we wouldn't have covered this ratio, but this ratio They're telling you how to calculate it. So you must still be able to calculate it. Then we have net interest cover. Net interest cover is not a profitability ratio. Net interest cover is a debt management ratio. Dividend cover, that falls under market value ratios. Okay, but they told you what ratios they want you to calculate. Maybe according to them, this falls under profitability. That's okay. So we will go through these ratios now. But in order for us to go through it, we're going to have to, what are we going to have to do? We're going to have to read the scenario. I'm only going to read up until business valuation. Because business valuation is for the valuation question. Working capital is for the working capital question. So we're not going to deal with that. We're not going to read with that now. So I'm only going to read everything up until business valuation. So they say Madlala is one of South Africa's leading gaming retailers and has an amazing range of video games, consoles, and accessories. With the opening of its first mega store at the Gateway Shopping Mall in December 2016, Madlala's business now consists of 6 stores in 4 different provinces. The company operates from leased premises, and its investment in non-current assets include intangible assets, equipment, and fittings. Lease restrictions have often hindered the company from creating a fun and play environment at its stores. But Lala is currently not listed in any stock exchange. You won't expect them to be listed because it's PTY Ltd. A private company is PTY Ltd. A public company is just Ltd. You can't be a PTY if you are listed. Okay, so just take note of that. Madlala is still enjoying the benefits of the successful launch of PlayStation 4. So take note of that. However, recently the Rand has come under severe pressure against major world currencies, and the management team is looking at ways to protect the company against currency fluctuations. Take note of that. So the launch of the PlayStation 4, so that means they're making good sales. Their revenue most likely increasing as a result of the sales, right? So the revenue can increase for 2 reasons. So the launch of PlayStation 4, it can also increase as a result of the new store, okay? Because now people can go to, the people in Gateway area can go to the Gateway Mall, okay? So revenue can increase as a result of those two. Costs can be impacted as a result of the currency that they talk about, and then also the opening of the new store. The opening of the new store will have increased marketing expenditure. The opening of the new store will also have, there'll be one-off expenditure that would take place when you open a store. So it may inflate expenses now, but it won't continue into the future, because into the future will just be your normal running cost of a store. But when you open a new store, there's certainly going to be one-off items that would increase costs. So if profits, or if operating profit go down, or if cost goes up, those are reasoning for the increasing. Okay, so just for the impact on a decrease in whatever. Then they say the company is also faced with the challenge of a decrease in buying power of consumers, especially following rapid hikes in the lending rates. Okay, so although the new store can generate more sales, and the launch of the PS4 generates more sales, the sales will, that increase in sales will probably also be somewhat offset by the lack of people being able to spend. Okay, so you might just look at those type of things. And then for your costs, if costs can increase, so marketing costs will most likely increase as a result of the opening of the new store. So when a new store opens, you'll increase marketing expenditure. Similarly, like when the PlayStation 4 comes out, you will do extra marketing regarding PlayStation 4 so that people can come to you and buy. How do you know this? If you just think about Musica. So I was at Clicks for about 3 weeks helping out over there. So I saw how the marketing teams, how they have certain campaigns like for things like this. When PlayStation 4 comes out, they have a special campaign for PlayStation because they can make loads of money when PlayStation releases. So they do extra marketing to gain awareness and all of those type of stuff. So when people see PlayStation 4, and they want it or they want anything relating to PlayStation 4, they think Musica. So when stuff like this happen, you would expect marketing expenses to go up, but definitely also because of and then also other costs would go up as a result um, of the new store. So just take note of that. And then also don't forget the currency thing. Okay, so the financial information. So there they have sales, cost of sales, marketing, licensing, administration, depreciation. Then they have profit before interest and tax. So this profit before interest and tax, in brackets, tell yourself that is earnings before interest and tax. And another word for it is operating profit. That's an important number for you as a because UNISA uses that number a lot in their ratios. Okay. So profit before interest and tax is also known as earnings before interest and tax. It is also known as operating profit. Then we have interest expense, interest income, and then we have taxation, then we have net profit, then we have dividends declared and paid, then we have retained earnings. Okay. Then there's some assets. They have non-current assets. Non-current assets is made up of intangibles, equipment, and fittings. Then they have current assets. Generally, a place like this is going to have inventory for sure. I don't know if they sell on credit, but if they do sell on credit, then debtors. Um, then we have equity and liabilities. We have ordinary share capital. We have reserves. We have non-current liabilities, and we have current liabilities. Current liabilities would be like payables, trade payables, creditors, um, SARS payable, and all of those type of stuff. Okay, so that is that. And additional information, they're telling you weighted average cost of capital is 15%. Similar companies, okay, companies not listed, okay. That this information here is for your valuation. So we're not gonna worry with that. So now let's calculate these numbers. Turnover growth, gross profit, effective tax rate, earnings before, and all of those type of stuff. I'm going to give you the formula. Then I'm going to give you guys 10 minutes. I'm going to put you into groups. I'm going to give you guys 10 minutes to work through the ratios. So let's see how many is in this class. Okay. So we're going to put you into groups of 3. So we're going to make 2 groups. Group 1. So I'll tell you who's group 1. Group 1 will do, is how many? 5, 7. Group 1 will do up until 1, 2, 3, 4, and group 2 will do 5, 6, and 7. Okay, so group 1 will do 1 to 4, and group 2 will do 4, 5 to 7. I'm going to quickly share my screen. I'm going to give you the formulas. I mean, not share my screen. I'm going to get Excel and then share my screen. So the first one is turnover growth. Turnover growth. So basically, that is just basically change in revenue. So turnover growth would be turnover growth would be latest. So current year divided by prior year minus 1. Minus 1. Another way to do the formula. This is the same thing, just another way. current year minus prior year divided by prior year. Same thing. Okay, so whichever way you prefer. That's the formula for that one. Then we have gross profit margin. So gross profit margin, that is going to be GP divided by revenue or sales, whichever number they give you, times 100. Then the next one is effective tax rate. So effective tax rate, that is going to be income tax divided by profit before tax times 100. If the ratio is times 100, then the unit is in percentage. Okay, so when you times something by 100, the unit is in percentage. Same thing over here, you can times it by 100, the answer will be in percentage. Ebitda margin, so that is earnings before interest and tax, depreciation and amortization. So Ebitda margin, EBIT, earnings before interest and tax, D for depreciation, A for amortization, is no amortization over here, divided by revenue. Revenue times 100. The next ratio is marketing expenses as a percentage of revenue. That ratio is telling you what you must do. It is telling you to say marketing divided by revenue times 100. So when the ratio is times 100, it is a percentage. Remember, you will lose marks if you don't put the measurement, the unit measurement. So far all of them are percentage. 1, 2, 3, 4, 5. Okay. Net interest cover. Net interest cover, very important. The typical ratio is called interest cover. Interest cover is finance costs or interest expense divided by, it is earnings before interest and tax, in this case, profit before interest and tax, divided by interest expense. So the normal ratio is called interest cover. So then you say earnings before interest, for EBIT or operating profit divided by interest expense. Another word for interest expense is finance costs. But they never ask you for interest cover. They ask you for net interest cover. So that means you must subtract interest income. Okay, interest cover, the unit measurement is called times. Okay, so you get a number and you just put the word times. And then lastly, dividend cover. Dividend cover is earnings or profit after tax, earnings or profit for the year, profit after tax divided by dividends. Okay, so this ratio could either be earnings per share divided by dividends per share, or so that one is on a per share level basis. So here I'm working on a total basis because that's the information given. So it's total earnings divided by total dividends. And this is also times. So now I'm going to put you into groups. Group 1 is going to do the green. Group 2 is going to do the blue. So I'm going to put in the groups now. I just need to stop the share quickly. Okay, so you should be in a room now, probably like in a minute or two. I'm going to give you, it's now 22 until 10 to. So room 1, you are, room 1, you are, you are group 1. Room 2, you are group 2. Okay, so group 1, you must do the first 4 ratios. Room 2, group 2, you must do the last 3 ratios. So I'm going to give you till 10 to. Work together, discuss it, calculate it, and then what do you call it? Fahim, Prashni, you need to join. Danal, Masina, did you join the group? Fahim, you need to join. I'll give you guys till 10 to discuss. I will hop in and out of the rooms. So talk to each other nicely. Don't be shy, and try to work through the numbers.
our profit before tax? What do you think?
Profit before tax, yes, that's correct.
All right, so then let's say that's going to be 615,000 Rand. So it's 191 divided by 615 to get the effective tax rate. I got a 0.31%. And then the last question we have here, it's the EBITDA margin. I don't know if you know the formula for this one.
Earnings before income tax, depreciation, amortization over revenue.
Okay, just hold on. Sorry, I'm just quickly writing down.
Sorry, it's very difficult without the question paper.
Oh, what a bummer. All right. So it's the earnings. Okay, yeah. Just as you said, earnings before interest, tax, depreciation, and amortization. So we have the profit before interest and tax.
Okay. We've got 2 comments.
Yeah, but you see, the management team is looking at ways to protect the company against the currency fluctuations.
Okay.
So that means they would have decreased their marketing. No, they would have.
We would have increased
No,
marketing
they would have.
because of the to get more income. Like
Yeah, for
generate
sure,
more
for sure.
sales.
I suppose. Yeah, and to increase the buying power of consumers, because they were seeing that there was a decrease because of the currency fluctuations.
Yeah, so they're trying to attract it.
Yeah, they're trying to market it more. Okay, cool. And then the increase in net interest cover. So the interest income, you can see that it increased, and so did the finance costs.
I think here we have took more loans. If you can check.
Well, I think it's more the fluctuation, the currency fluctuation.
Okay, guys, can you give us some feedback? So, if you can give me some feedback, we will go with room 2 first. So I think that was Kelsey, Bungani, and Danielle. And I think Kayla and Prashni was in room 1. So Fahim's thing, he was unable to join, and then I kicked him out and he couldn't rejoin. So sorry, there are some technical issues. So sorry about that for Kayla and Prashni. He messaged me to tell me that it just couldn't work. So Danal, Pungani, and Kelsey, let's go with you guys first. So you had to calculate 3 ratios, I think. It was, let's just see quickly. It was marketing expenses, net interest cover, and dividend cover. Oh, so Kayla were, yeah, let me just, was Kayla, not Kelsey. Okay. Okay. Yeah. So let's go through it quickly. For marketing expenditure, how did you go about calculating that ratio? Yeah.
Do you want me to go, guys? Okay. Well, we took marketing expenses divided by revenue. We calculated it for the first year and for the current year and the prior year. And the current year we came to 5.5%, and the prior year was 4.6%.
Okay.
And we thought that it increased because of the sales increased because of the successful launch of PlayStation 4 and the new shop opening. Marketing expenses also increased because of those 2 reasons. And then Masina said that, and we agreed with him that maybe there was more marketing because of the buying powers of a decrease in buying powers of consumers. So there was an increase in marketing costs, because of that.
I'm just really,
because they were protecting, well, the management was protecting the company in that way, trying to up the marketing.
So 2017, 2017, 2016. So I'm going to do this one. Okay. So the answer should have been 133 divided by 2.4. So it's equal to 133, 123 divided by 2.4, 123 times 100. I was in one of the groups and someone never got the question paper. We sent out the email with the question paper. Somebody just let me know if you didn't get it, so then I can resend it somehow, or maybe I send it via WhatsApp. So for someone that didn't, just let me know. Who never got the question paper? Okay, so 2017, it is that. 2016, it is 102. 123 divided by 2180. 2180, 123. Okay. Let's see, some send me a message. Okay, so maybe you never received the email, but you were also making mention, Prashni, that you never got the link. So in the email where I sent the link, the question paper was included in that email. I will send you the question paper afterwards. So you can see marketing expenses increased, okay, from 2016 to 2017. So although revenue increased from 2016 to 2017, marketing expenditure also increased from 2016 to 2017. So you can, the reason over here could be that it is as a result of the new store and the launch of PS4 that what caused the increase in marketing expenses relative to revenue, despite revenue also increasing. So that is just basically what you would say. So generally how companies do it, like generally, I don't say it's always that way. They would set a budget and they would say the marketing expenditure will be 10% of revenue. So they expect revenue to be R1 million. They're going to spend 100,000 Rand on marketing campaigns. But remember, you first spend the marketing campaign, then you make the revenue. So maybe they spend their 10% at what they anticipated, but the revenue increase was not as much. Okay, so here it was, you will just say, although revenue also increased, the marketing expenditure, the increase in marketing expenditure offset the increase in revenue. And the main reason for marketing expenditure the main reason marketing expenditure increased could be possibly the launch of the PS4, as well as the opening of the new store. So just think logically. Whenever a new store open, companies advertise it, and they certainly advertise. Like for example, like Musica always advertise when a new PlayStation comes out. So just keep that in mind. And many places that sell the PS4 is going to advertise because they want people to come buy it from them. So that is the reasoning. So we'll just say comment increase as a result of the new store opening and launch of PS4. That just basically, you can just say that. Okay. If you want to give a little bit more, you could say that yes, the increase in marketing expenses was more than the increase in revenue. Okay, so that is one line. No need for a thesis. Okay. Next one, interest cover. In net interest cover. Net interest cover. Interest cover. So net interest cover is earnings before interest and tax. So earnings before interest and tax, that is your profit before interest and tax. Earnings, profit, same thing. Okay, divided by interest expense minus interest income. So 693. So this is going to equal 693,123 divided by interest expense, which is 105 minus 27,000. I think I saw 27,000 minus 27,000. Okay. So remember the over here is not a percentage. It is, you will use the word times. Wouldn't we add back depreciation? No. Because we're working with earnings before interest and tax, not earnings before interest and tax and depreciation. Over here, you will add back depreciation. over here, when you work out EBITDA, then you add back depreciation, but not when you work out earnings before interest and tax. So just earnings before interest and tax. So not earnings before interest, tax, depreciation, amortization. Only when you calculate EBITDA, then you add back depreciation. Okay, so interest cover. Interest cover. So remember, you must put, so I can't now put that there, but I'll just write it over here. It is times. Okay. So I'll just put the units over here. Times. Just remember, you have to put the units in. I can't put my units in over here because I'm using a formula. Excel will then show an error. So I can't put the unit over there. 2016, we do the same thing. It is equal to earnings before interest and tax. So profit before interest and tax is what we're looking for, 640 divided by, so usually you only divide it by interest expense. If they ask you for interest cover, we only divide by interest expense. But here they ask us for net interest cover. So it's interest expense minus interest income. So 88,000 minus 5,000. Okay, so a higher interest cover is always positive because you are saying earnings need to reduce by 8.8 times before you run into trouble. Over here, earnings must reduce by 7.7 times before you run into trouble. Another way you can see it is your earnings can cover interest 8.8 times. Over here, earnings can cover the interest expense 7.7 times. So the more earnings can cover interest, the better for you, the more safe you are. So, sorry, when we comment, we need to say improved, and then you give the reason. Same thing over here. Sorry, not improved. Okay, deteriorated. Well, whether it's improved, I'm going to just use the word increase or decrease. Okay, over here, also an increase. What we're going to say, what's the reasoning? So what is interest? So it's earnings before interest and, so it's earnings before interest and tax divided by interest expense. Interest expense increased this year relative to last year. So last year it was 88, this year it was 105. You expect interest income to be higher. The reason being is, if you go to the balance sheet, non-current liabilities is higher. So generally non-current liabilities is going to be your interest-bearing debt. So the higher the interest-bearing debt, the higher the interest. So you expect interest to go up over here. And interest did go up because your non-current liabilities is higher. Okay. So then what caused the increase? You can just basically say the following. So it increased due to increase in interest income. So if you look at interest income this year, it's 27,000 versus 5,000. So remember, we are taking net interest cover. So we're subtracting interest income from interest expense. By interest income being significantly higher relative to last year, it is reducing interest expense significantly more than what it reduced last year. So that has a positive impact on our net interest cover. So due to the increase in interest income relative to 2016, okay, and I just want to see something over here. So if we do calculation 4 and calculation 2, we may also conclude that earnings before interest improved. So then that will also have an impact on our net interest cover, but we'll get there just now. So that is one reason. So here we're going to go to dividend cover. Number 5, dividend. Number 7, dividend cover. It is earnings. So it's profit after tax or profit for the year. So that is in 2017, profit for the year or net profit was 424. Dividends was 128. So it is 424, 123 divided by 128, 123. Then we have last year 395 divided by 107 equal to 395, 123 divided by 107, 123. So last year the dividend cover was a bit higher. Okay. You can maybe suggest that due to pressure, due to the environment, consumer pressure and so forth, the company declared a lesser dividend relative to the prior year. So here decreased. So remember, a company, with dividends, the way a company would declare dividends is based on the circumstances. Okay, so the only rationale over here could be that they're a little bit skeptical about the environment, and hence they declared a lesser of a dividend relative to the prior year. So that's the only thing that makes sense relative to the context. So one possible reason, there could be many reasons. So one possible reason could be perhaps due to consumer pressures, the company decided to declare a smaller dividend. So you need to understand your other topics as well, okay, just to get some context. So given this scenario, the way a company declares dividends, so your Shoprites, your Pick n Pays and so forth, they are established companies, your MTNs and so forth, they are established companies. So there's two types of theories when it comes to dividends. You get the residual theory and you get the active theory. The active theory or the passive theory. Another name for the passive theory is the residual theory. The active theory says we give a fixed dividend. So either we're always going to declare 2 Rand per share, it's a fixed dividend, or they're going to say they're going to declare 10% of profits. So they give a fixed ratio. So Shoprite, for example, their dividend cover is 2. So whatever, if they make profits of R1 million, they declare dividends of 500,000 Rand because they have a dividend cover of 2:1. So if you just go to Shoprite, go in the past 5 years or 10 years probably and calculate the dividend cover, you're going to get 2 all the way. So that tells you the dividend cover is 2. Established companies generally do that. A company that is generally still growing, have lots of opportunity for capital expenditure and so forth, they're not going to spend much on dividends because they're going to take their money and reinvest it into the business. Similarly, a company that may feel a bit skeptical in terms of the current environment and the future trading environment, they will hold back onto dividends. Look at many companies when COVID took place. lot of the companies never paid a dividend because they wanted to play it safe because they're not sure how the environment's going to play out, especially medical companies, especially insurance companies, because they don't know what's going to happen. People's going to take their policies. People's going to claim for insurance, medical aids and so forth. People's going to use their medical aids to go for tests and sickness and all of those type of stuff. So those companies don't declare a dividend because they're uncertain regarding the future, what the future is going to hold for their trading environment. So same thing over here. It's very marginal decline. So a possible reason over here would be that due to the consumer pressures, the consumer buying powers, that the company decided because there's a pressure on the consumer, as a result of the pressure being on the consumer can't spend on the company. As a result, the company will suffer from a revenue perspective. So that could be a possible reason why they have a decline in dividend cover. Okay. That is, so that is how you need to understand also your various topics and how it makes sense from a business perspective. I know it's not easy. When I was in your shoes, I also didn't really understand. I only get to understand it now because being in the real world for some time, being involved in financial accounting, being part of in audit, listening to rationales from management, working closely with finance managers and FDs. So I understand how they think now. So I'm trying to give you that type of context for your while we do our course as well, so that you think more like someone that's in the real world already, as opposed to just thinking like a student. I know how it is to think like a student. I only thought like a student because I did not have the real world aspect. I guess the positive for you guys is most of you are working. You work full time, and most of you are in the finance departments and so forth. So you may also be closely working with the finance manager, the head of finance, or the FD. So you also know how they think. Or you can, even if you don't work closely with them, you may listen to their conversations, hear their conversations, then you would understand how they think. And that must give you some insight into how to comment given the context of this scenario. So just take note of that. As you can see, I wrote in one line, I didn't write a thesis. In the real world, you may have a more detailed explanation if you're an investment analyst, but even for a normal company, it will be such a simple example. Then we're going to do turnover growth. So turnover growth, turnover growth is just basically the change. Okay, so we can't work out 2016, but we can work out 2017. So it's going to be 2,400, 123 divided by 2180, 123.
Faiz,
Yeah.
Prashni and myself did this question.
Yes.
We might not have some explanations, but I do feel that maybe Prashni can join in and go through the calc, and we can both kind of give an explanation.
That's fine.
All right, so yeah, we got 10%.
Okay, yeah.
And I'm sure Prashni, you can add a comment here. I think it's grew by 10%, most likely because of the PS4 sales and the new branch that had opened up.
Yeah, it's perfect. Increase due to new store and PS4 launch. Okay, PS4 launch. Okay, next one.
Right, it was the gross profit margin. So it's your cost of sales over revenue. For 2017, we got 54%.
So for gross profit margin, what are you going to say?
The reason.
No, I'll give you the number.
Oh, I got
How
54.58%.
did you get that?
I took 1,310
Cool.
divided by 2,400,000.
Okay.
Yeah, so is that right?
Yeah.
Okay, all right. And then I quickly did a calculation now because Prashni didn't have the paper. So, and I also forgot to do the previous year, so I quickly snuck it in. So I took 1,200,000 divided by 2,180,000, and I got 55.045%.
Okay. Yeah,
And
so you can see what is that? 1% really is marginal, right? But generally for a retail store, so for example, like for Pick n Pay and ShopRite, this small difference will have a significant impact on their profit. I'm not so sure from a store like Musica and so forth. I don't know if their margins are tight, or if they have a higher margin, maybe. But I mean, like PS4, I'm pretty sure those type of items will generate a higher margin. So this minor change is not really as significant, but this maybe not as significant, but like for Pick n Pay, a 0.05 is a lot. Because their margins is literally 1%, 1.1%. So 1% versus 1.1%, that 0.1 have a significant impact on their profits because of the large volume that they sell. The volume of a store like this relative to Pick n Pay won't compare, right? So this mega store won't have so many sales that change in this will have such a significant impact. But for Pick n Pay, a change like this would have a significant impact. Just do the gross profit calculation for Pick n Pay ShopRite. When I used to do it back then, I think it was like 1 point something or 3 point something, very small. Gross profit margin, very small. So that a 0.1% is significant for them because of the volume of sales that they make. So just take note of that. Okay, so give me a possible reason.
I was thinking that maybe their purchases might have been a lot higher, and their closing stock might have been a lot less
So
at year end, as well as because it's a bigger company. While they opened another branch, they might have just had more purchases and not as many relative sales.
Yeah. So it could be what you call it. So there's endless number of reasons. There's no specific reason over here. They never spoke to us regarding cost of sales and whatever. So a possible reason would be that for a new store, they had for a new store they had increased number of increased number of revenue stock, so that it can have an impact. Or it could just be that the cost price of the stock, it was higher relative to prior years. Okay, so we don't know what it is. Here you can make up something that makes sense within the scenario. So like a typical reason would be increase in costs higher than increase in revenue. Okay, possibly so possibly cost of sales higher, cost of purchases higher than anticipated. Here you make up something. make up something that makes sense, because it's nothing specific in the scenario. So you can't pinpoint to something specific in the scenario. So therefore you can make mention of that. Well, although a potential reason could be foreign exchange, because the PS4 you're probably buying from overseas, and as a result, they have a foreign currency fluctuation. Because 2017 had a high forex fluctuation, that could have had an impact. They never told you that, but you must know PS4 is an international brand. Where are we going to get the PS4? We have to import it. So there's a foreign currency impact on cost of sales, and because forex was highly fluctuating, it could have had an impact on here. Okay. Okay, so just be aware of that. Okay, two more. Let's do this one now. We will have effective tax rate. Okay, so what do you have?
For 2017 was 191,000 divided by 615,000.
615,000. Okay, that's 31%. Remember, the tax rate in South Africa is 28%. So the tax rate for the corporate tax rate, the tax rate of a company is 28% currently. Next year in April, it's going to be 27%. But now currently it's 28%. So you expect it to be 28%. It's hardly ever going to be equal to the 28%, but there's always differences between how accounting treats something and how SARS treats something. So it won't always be 28%. So here it's higher than 28%.
All right.
So that means there was some expenditure that they couldn't deduct, and that is why it is higher. Okay, so the next one is 160.
Yeah, sorry, go ahead.
Divided by?
557,000.
557,000.
Yeah.
So as you can see there, so there must have been some expenditure that they couldn't. We're not going to comment on this. We don't know what the reason is. Do they want to comment for it? I don't know. We will see now. But it must be that some expenditure couldn't have been deducted, or I don't know what it could be.
I can say that maybe they paid penalties for late payments, so they added it to their taxation.
But we don't know. That is possibility. There's various possibilities.
Possibility.
Yeah, and could be like there was some expenditure that is not deductible. Okay. And then earnings before interest and tax. What is that now? Ebitda percentage. So here is where we must add back depreciation. So Ebitda is going to be 693,123 plus depreciation, which is 75,000, divided by, what is this? Ebitda divided by sales, which was 2.4 million. Okay, 32%. The next one, what was the next one?
The next one was 640,000.
640,123 plus
plus 65, yeah.
65. Okay,
divided by 2,180,000.
Oh, 1, 2, 3.
Yeah.
Once again, very marginal. You basically going to say it is more or less the same. Okay. More for ShopRite, this is big, but for this people, I don't think this is big. So you can just say it's more or less the same. Okay. Decrease, which is an decrease, which is basically not so good, but it is more or less the same. Partially decreased due to increase in costs offsetting increase in revenue. Okay, so the increase in so due to increased costs, due to marketing expenditure, new store opening, and forex fluctuation. What you're going to learn when you get into the real world, less is better. You need to know more, but say less. When in the last company I worked at, the FD wanted all his financial accountants. So you have the financial accountant, the head of finance, and then the FD. So the FD used to present to the board, but then he felt there's too much work for him, and then each of the financial accountants had to present. So myself and another my colleague that time, we had the biggest companies for our company. We obviously part of a group. So the company I looked after, which was the long-term insurer, and my colleague was looking after the asset management company. We were the big companies. So we generally had board meetings, but there were some other teams and other people as well, other colleagues as well. But like I know for me, because I'm a long-term insurer, so long-term insurer is highly regulated. So they are required to have more board meetings than all the other companies. So basically every quarter, the FD had to present. But if they didn't want to present anymore, then we had to present. But obviously before we present to the board, we must present to him. So I would go up to the FD, have my numbers, he will check it. Then we have to give commenting. But we work together, but I must give him the reason and he will tell me how to word it. So I would give him like a long explanation like this. Then he'll tell me, no. Just say increase and simply like this. Costs, profit increased as a result of an increase in revenue and was partially offset by an increase in costs. That's it. But in the back of your mind, you must know more reasoning. If the board asks more questions, you must be able to answer. But you say as little as possible, because the more you say, the more questions they have. So to minimize the questions they have, you say less, but no more. So in the event they ask, you're able to answer. So I would know why revenue increased. I would know why cost increased. So if they must ask, I can tell them why. But while they don't ask, you just quickly, it tells you, keep it to 1 minute, not more than 1 minute. Run through the numbers, quick. We're just doing it for compliance. Do it quick, and that's it, to avoid questions. And you literally say, I literally had to go, revenue went up by 10%. Give one reason, mainly due to increase in money coming in. Okay, so increase in net assets, or increase in investments. Then we go, costs went up, main reason, salaries. As a result, profit went up due to profit went up by this percentage due to an increase in the revenue, as mentioned above, but was partially offset by cost. Done. Move on. And you don't even try to give him time to ask you questions. They must stop you to ask you questions. He literally wanted you to be 2 minutes, done. So same thing over here. Although in an academic world, they want more, but you must write less that says more. Don't want to write a whole paragraph that's saying that is mixed up. Try to write one line, bullet point form, that is to the point, that you will get your marks. When you start to write too long, you end up jumbling things, and that's when someone reads it, they know what you are saying, and then they tend to not give you the marks that you deserve. So try to write less, but saying more. So just think about that. It's very important. Like they say at school, they will always tell you, write an essay in a minimum of 10 pages. But in the real world, when you want to convey your message, they tell you convey your message in less than 10 seconds. You see the big difference. So the school don't teach you for the real world. Nobody have time to listen to you to read off 10 pages. They only have 10 seconds for you. So same thing over here. Although in an academic world, you still want a little bit more meat. Try to keep it to one sentence, and your niece is quite specific. They tell you, if you read the cut letter, they'll tell you, keep it down to one sentence. The explanation must not be long, but it must still make sense. So just take note of those type of stuff. Okay, that's it for me for this week. Do you guys have any questions? Prashni, I will send you that question paper later tonight. Any questions from you guys? Daniel, Taylor, Kelsey, Bongani, Prashni, any questions?
No, good.
Okay, cool. Thank you. Pleasure, Taylor. Who said no questions? I didn't. Bongani, any questions?
So far, no question.
All good.
Okay, Daniel, all good. Kayla already responded. Prashni, Kelsey. Okay, Kelsey, all fine. Prashni, any questions? Okay, all good. Okay, I'll send you that question paper later. Maybe the email will also come through later. But I'll see you guys next week again. We'll continue on this question. Oh, don't forget your homework. If you want me to provide you with feedback, submit by Friday. Friday, remember, 12 o'clock is fine, the night. D, E, and F. Okay, question 1, D, E, and F. Okay, see you guys. Bye-bye.